Get started. So appreciate everybody coming this morning. We're here to talk about structuring deals for success. Let our panel introduce themselves here in a second. My name is Greg Vermakis. I'm a partner with the accounting firm of Cohn Resnick. I'm our national director of lodging. Handle from your normal financial reporting, tax needs, and consulting. Also, I have a smaller niche in the redevelopment of historic buildings into hotels using historic tax credits. It's a passion and niche of myself and our firm. Let the panel go ahead and introduce themselves. Starting this side with Ben.
Hi, Ben Brund with Noble Investment Group. We're an Atlanta-based hotel investor and developer with a focus predominantly on select service, extended stay, smaller box, full service, compact full service. This is our 30th year in business. We invest today, as we have been doing for the last 16, 17 years, through a discretionary fund model. Currently investing Fund 5. We had a target fundraise of $800 million. We've just exceeded that, and we'll keep fundraising for the next few months with a hard cap of $1 billion. Have been very active over the last couple of years. Made about $1.5 billion in investments. Really, after a pause in 2020, we really started investing again in March of 21, and been a little bit slower this year. I'm sure we'll talk about that here on the panel, but still very active in both ground up and acquisition.
Hey, good morning. I'm Brian Waldman. I'm the Chief Investment Officer at Peachtree Group. We're a vertically integrated investment manager. So we invest up and down the capital stack. We buy hotels, we build hotels. We have a lending platform called Stonehill that finances hotels. We have a management company. We currently operate about 100 hotels. We play a little bit outside of hotels as well, but the majority of our AUM is in hospitality. And we're a value-add investor similar to Ben. We invest primarily through fund formats. We're on our 13th fund. We have about $2.5 billion in equity under management today, and excited to be here to talk on the panel.
Mike Wilbert, Managing Director of Acquisitions at Mission Hill Hospitality. It's a Denver-based private equity fund investing in select serve and extended stay hotels across the country. A newer entrant to the space compared to my colleagues up here. We've been in business about 2 years now. Acquired 26 hotels during that span, and look to grow the portfolio, investing in similar products as the group up here.
Excellent. Nelson Knight, President of Real Estate and Investments for Apple Hospitality REIT. We own 220 hotels spread across 37 states. Like to be broadly geographically diversified, focused on rooms-focused select service, extended stay brands, Hilton, Marriott, and Hyatt. Over the last, really since the start of the pandemic, we've transacted on just over $800 million in deals, both on the sale and acquisitions front, and been a net acquirer over that time period, and continue to be active in the space today.
Excellent. So when we looked at the idea of what a successful deal structure looks like, we really looked at two aspects of this. The first piece is the asset itself, and then the second piece, which I'm sure everyone is chomping at the bit for, is going to be the debt and equity discussion, especially as we talked a little bit briefly. Right, we're expecting an announcement from the Fed today on an interest rate increase, so we're talk about the debt and equity side of structuring the deal as well. But to start out, you look at coming out of the pandemic and where things are, talking about actual product selection. You look at coming out of the pandemic, if you asked a hotel developer, they would be extended stay, drive to destination, right? That was the model that everybody was looking for because it's where all the revenue was. When you look at product selection and you look at that aspect, have the market dynamics changed since the pandemic, since we're 3 years past? And when you look at the horizon, what we're talking about with the capital stack, Do we see that those are still going to be the dominant factors in the market, that, you know, extended stay and drive to destination, or are there other things we're looking at?
I can go ahead.
Anyone, sure. Anyone.
I mean, I think from our perspective, we certainly saw extended stay and drive-to markets. Leisure, I would add to that mix, perform exceptionally well through COVID and coming out of the recession. You know, part of the reason we invest in those type of products is they tend to fare extremely well at all points in the cycle. So both during economic booms and busts, that product type does very well. And I think the stability of that platform was highlighted during COVID and will remain relevant for, you know, a long time.
Yeah, I agree with those comments. I also think when you look at, you know, select service, compact full service hotels, you know, they tend to perform well. I think that, you know, we've seen a lot of groups lean into them. Over time and over cycles, they, you know, they present a great investment opportunity. I think what we're seeing, you know, in terms of the drive-to leisure, obviously those assets got run up. You know, we sold a number of assets in Florida, you know, post-COVID, just because that's what everyone was flocking to, and you know, getting great pricing for it. But I think there's really two parts to it. One is performance, and from performance, from an investment, you know, putting on my asset manager hat, I love those investments. When you look at it from an acquisition standpoint, we also look at where are the opportunities, and I think that a lot of money has chased those, you know, those drive-to assets that makes it cost prohibitive to buy those. There's not a lot of product out there today. We're all looking for a product to buy. So I think from an investment perspective, sometimes you have to be a little bit contrarian and look to other places. And again, we love select service, but moving away from those, you know, drive-to leisure, there's, you know, urban markets that have been overlooked because corporate hadn't come back, and now corporate's coming back. So from an investment perspective, I think you're starting to see more interesting opportunities there.
Go ahead, Ben.
Yeah, just to add on to that, I think, you know, it's a segment, you know, that has gotten a lot more interesting from a product standpoint in the last decade. And, you know, you now have, you know, even lifestyle brands that have really, you know, entered this space, you know, with the backbone of select service, and, you know, we've all done, you know, a number of those. And then, you know, when you look at it from also from a renovation standpoint, the square footage of the box, what you have to do when, you know, when it does come time to, you know, take that next step and reinvest in the product, you're just dealing with less square footage, it costs less, and, you know, we find that to be a meaningful, you know, aspect of the investment as well. And, you know, you see a lot of older boxes, you know, that never really appear consistent, and a lot of that is just based on the cost, the square footage, and really the ability to get that product to a consistent level.
And the product itself is efficient to operate as well, which we saw during the pandemic. We were able to flex a lot better on our select service assets, you know, where we needed to.
With the pressure on, you know, pricing and the pressure on demand for those assets in those areas, obviously, and one of the things, you know, we'll talk about the economics and the debt and equity markets, but is there enough elasticity and rate at that select service to continue to, you know, drive that demand, or do we need to start looking at a, you know, again, the rates at luxury tend to be a little more elastic. Is there a play for luxury in the future, or is it still that general select service, you know, extended stay demand? Up.
Well, I mean, from our perspective, and Mike, you can jump in. You know, from our perspective, our portfolio has, you know, weekend is still outperforming, but we're seeing huge strides weekday. So, you know, we were up Q4 over 19, 7% in RevPAR, but that only represented about 60% of our hotels that were performing above 19. So we still see runway and tailwinds for, you know, continued growth, but it's more in the weekday sector versus the weekend.
Yeah, I mean, your Tuesday, Wednesday nights, you know, pre-pandemic were always you could always sell out. Mondays, Thursdays were, you know, kind of your shoulders, and then you had your weekends. And I think a pattern that we've noticed in our portfolio is that, you know, Thursdays and Sundays have now become a lot more reliable, due to the kind of a work from anywhere, component that's come into, a lot of folks' lives. So we're seeing kind of an extra day, in the week that is now much more reliable than it was in the past.
Yeah, I think that's an important point, just to piggyback on that. I think going into COVID, a lot of people had concern, work travel is going to go away, there's, remote office and all that stuff. And I'm a big believer that the pendulum swings and then it swings back. So I do think, you'll continue to see this movement back to the office. But I think what has changed, or what I've seen change in our office, is my team isn't remote, we're there, but if someone wants to, work from home or work from somewhere on a Friday, we're okay with it. So the concept of bleisure is, I think it's definitely becoming a real segment where people are tacking on a day or two, which is helping in the shoulder periods. And we're seeing that help drive, occupancy on the Sunday nights like Ben's talking about. And I also think, even if I'm wrong in my statement that people are coming back to the office, which I don't think is the case, but like if you look at, I'll pick on the tech sector because, I think they were one of the most vocal, we're getting rid of our offices, go live wherever you want. Well, that's great, but the other piece of it is you still have to be back in the office 1 week a month so we can meet and do all of that stuff. So it's creating a new segment of demand that we never really had before. And, that's really good business in a lot of these markets. So I think even though we went through, some pain, I think coming out on the other side, I think it's going to be really good for our industry and for our segment.
One thought on your question about pricing power and elasticity. What we're hearing from our asset management teams is that the blur in product, where it's still select or it's still focused service focused, it's becoming more elevated. So the consumer is willing to pay a little bit more for that product. And the other factor is supply. With the sort of the muted pipeline in the markets, we can drive rate at an extended stay limited service product that you couldn't do 5 to 8 years ago, just because there's no other competition in the market.
Gotcha. I think just to piggyback on that too, I think in our space, new wins over old. And you've seen development pipelines significantly slow down, whether it was, going back through the banking crisis, COVID, and even talking about renovating assets, to piggyback on Ben's comment, as you're renovating assets, I think in our space, new wins over old, like new wins over old. So if you're able to renovate a product and bring it back to like new quality, you're going to see, particularly when you're talking about the premium brands, you're going to see that pull business from other assets. When you start talking about some of the older boxes that are functionally obsolete, and I'm not going to pick on a specific brand, but it doesn't matter how much money you drop into certain boxes, it's not going to feel like the new prototype for the brand. So I think it's really important to make sure that you have the right box that you're investing in, that you can bring to that like new quality. And if you do that, you're going to outperform in your market.
And pretty early on in the pandemic, we looked at our portfolio, identified markets that we felt would be slower coming out of the recovery, and had higher CapEx needs, to your point, Brian, and target those as potential dispositions. And on the flip side, invested in newer, younger assets, and the net result of that was an effective age on our portfolio of 5 years. So either 5 years since its last renovation. So trying to maintain that younger, more vibrant product that attracts the consumer.
And one of the things we spoke about is, for a long time coming out of the recession back in 2010, the industry's, the ability to develop or acquire hotels in terms of debt, equity, financing, and alike were pretty formulaic, right? I mean, it was pretty, you knew what you needed to do, you needed the steps in line. I think with, the pandemic and coming out of the pandemic and now looking at some of the financial things we're going to talk about here shortly, it's, having a true, like, whether it's good times, bad times, right? The ability to, understand your relationship with either your lenders or your investors, and understanding the fine details of those agreements that, tend to rear their ugly heads sometimes when things aren't going so well. When you look at structuring a deal or you look at structuring a transaction, what are some of those, areas of an agreement that, you didn't necessarily think about originally that now, after some of these things we've been going through, that are now at the top of your mind, and you make sure you understand the details or you negotiate those terms specifically for the benefit of the for the betterment of obviously yourselves. Like some of those things that you just took for granted never really came up because things were good. What are some of those things you guys look at now when you're looking at structuring a deal?
I think one that's coming up more frequently today is liquidity in what you're holding on your balance sheet, and then also reserves for PIPs upcoming, and what you underwrote 18 months ago for a PIP reserve is now a different number. But that's something that we're paying more attention to in the finer details of the loan agreements.
We always want to, be rewarded for success, and that, you never know that, or when that's going to necessarily arrive on the front end. So, a lot of things that we work on, with our lender partners are, if we can't get to 65%, maybe we start at 60 and we work on an earnout, that's based on, asset performance, or after we build an asset, it opens successfully and, we hit a certain threshold that we can actually have a decrease in the spread, of the rate. So we spend a lot of time, focusing on, little tweaks that, that reward us for success.
I think flexibility is also super important. When you go into a deal, everyone thinks that they have a plan until the world changes. And, I've been a big proponent about knowing your lender. We borrow from, balance sheet lenders. I see some of those lenders in the room, and, we really appreciate those relationships. When you look at, COVID or the financial crisis or specific points in time where, things change drastically overnight, you need to have someone that you can talk to. You want a relationship lender where you can work through some of those things. On the flip side of that, when things are good, you want flexibility as well. CMBS, where you're locking into a longer term. I can't tell you how many times I've talked to groups that are buying an asset and they say, this is going to be a legacy asset, we're going to hold it forever. And then 2 years later, they outperform or they underperform and they want to sell. It's having that flexibility to, to move, pivot as you need to with an asset, I think is critically important.
Is there any expectation with, some of that volatility for whether it's lenders or it's investors to, think about different reserves? Are there operating deficit guarantee reserves? Are there debt reserve, debt service reserve that they're now thinking about to, again, kind of stem some of that, volatility that may exist depending on where the markets go? Or is it traditionally, Mike, as you mentioned, just CapEx reserve?
I think it's all the above. What we're seeing, and we see it through a few different spectrums, one as a borrower, we see it as a lender, and during COVID we were a very active note buyer, and when we buy notes, our goal is to restructure those notes and work with the borrower. But in all of those cases, the one thing that I would say is liquidity is critical, and whether or not your lender is requiring it to be in a certain bucket, things change, things happen. And it's really important that you have the ability to double down. If it's your last dollar and you don't have the ability to put more capital into an asset, you're going to have your back against the wall, whether it's renovations or your note gets sold, or you have a loan maturing. And what we're seeing today is there's a lot of debt that's maturing, and different lenders are taking different approaches as to how they're going to handle that. But in the majority of the cases we're seeing, the lenders are going to want something. They're not just going to let you extend, and that might be a pay down, that might be additional reserves, that might be recourse. They're going to likely want something, and you have to have the ability to do that, whether or not your loan says you have this reserve or that reserve.
Yeah. It's just about prudent, kind of disciplined approach to your budget. You want, if it's a development deal or a deal where you've taken, rooms out of service for a major renovation, having some kind of operating deficit reserve. We're disciplined about including that. For those, groups that get into kind of a regular, cycle of distribution, to Brian's, equity distributions, to Brian's point, when in times like this, you may want to hold off, a little bit and, continue to build that reserve, because, a lot of us, will be having discussions around, pay downs for extensions and things like that. So having that buffer is generally a prudent way to think about it.
I think that's a great segue, right? One of the things that, we said, we wanted to talk about debt and equity when we're looking at structuring a deal, right? There's the two components of this. There's the debt component, there's the equity component, and certainly, over the last couple of weeks as it relates to the debt markets, we're all aware of what's going on, right? We've got SVB, we've got Credit Suisse, and we've got, as I mentioned, we got the Fed coming out today with what is expected to be a 25 basis point increase in the rates. When you look at all of that, for lack of a better term, noise as it relates to, the debt side of the equation, how big do you guys think the leverage pullback is going to be from banks, especially, Brian, as you mentioned, right, we've got a lot of debt coming due, and the question is how old is your debt, right? If it's 7+ years, you still, if we pull back to a 50% loan to value, we're probably still not going to have a pay down situation possibly. But there's others with shorter term debt that you may have to come to the table. What are we thinking about the debt market based on what we've seen over the last couple of weeks? Do we expect any huge impacts?
I think from our perspective, and we're structured a little bit unique in the fact that we're roughly 20%, 28% levered across our portfolio. So we've always had a conservative view on leverage. We believe the industry that we operate in is cyclical. We want to create stable returns over time and have a flexible balance sheet that allows us to be active at all points in the cycle. So in July of last year, we redid our credit facilities, enhanced them, and have a significant amount of capital that we're looking to deploy today. But as we look at the broader markets, I think you have CMBS that's essentially dried up, non-existent. It's been that way for some time. You have pressure on smaller regional banks and deposits being pulled from those. So it's going to be choppy over the next little bit. So making sure that you have a solid investment model, that you're able to leverage your strengths is important in this time, and the relationships that you have with your current lenders.
I think Brian said it right. Relationships. This is nothing but a relationship business, and we spend a ton of time with our balance sheet lenders. Look, it's not a good week, or this week, last week, maybe next week, not a great time to be in the market. Talking about new financing, but our expectation is that given the relationships we have, that we'll continue to be able to transact when we need to. Terms may be a little bit different, but again, it gets back to kind of how you tweak it, from a overall term standpoint, and working along those terms to kind of get where you need to be ultimately based on performance.
I think it also depends on where you're playing in the capital stack and what you're looking for. If you're going to a balance sheet lender at 50% and you're putting up recourse, that's going to look really different than going to a debt fund at 65% today. I think what we're seeing across the board from a lending perspective is many lenders are de-risking, which means that they can take on better credits, stronger sponsors with less risk, lower LTV, and get paid better for it. So everything kind of pushes down from there. So if you have an expectation that you were working with a regional bank and that regional bank is now out of the market and you have to go to a debt fund, it's a different model, it's different pricing, and you just have to be kind of aware of who your counterparty is and set expectations. I think from an LTV, LTC perspective, in this market, we're taking the approach of, granted leverage is pulled back, but we're definitely doing lower leverage on our deals just because of the volatility that's in the market. I can deal with the volatility in the market. I don't want to deal with the volatility in the market and have a high leverage position. If I could buy right today, I can get through some of that and then refinance in a couple of years when hopefully the market's in a more stable place.
We've taken a similar position. We've always underwritten on a leverage, an unlevered and a leverage neutral basis to our portfolio. So we want the deals to make sure that they work on their own, and then that allows us to really work through the current environment from a debt perspective.
We've seen a heightened focus on in-place debt yield. And to Brian's point on sponsorship, historically, you could underwrite, from the borrower side, you could underwrite a ramping property to stabilize in 2 or 3 years. That's normal, and we think that's fair. However, lenders today are less inclined to take that risk because of the macro market, so they want to see a double-digit debt yield in place today or in year one. So that's sort of, I think, holding back lenders a little bit today.
This is also kind of a time period where lenders may not take on new relationships. So for those of us that are hotel-centric, hotels call it specialists versus part of an allocation shop. This is a very good time to still be in the market, still looking at deals, focused on your relationships, because a lot of the folks that do invest in all asset classes, they may choose to pass on hotels right now due to the volatility that Brian mentioned, or potentially heading into a recession. They say, well, that's not the product type that we want to focus on. So less competition in general, I think, is, even though there's a lot of capital on the sidelines, for hotel-specific, hotel-specific asset class, it seems like there should be less competition going forward, really in the back half of this year as perhaps, the opportunity set begins to grow.
Do lenders at any point, do lenders look at even more specialization within the industry, meaning someone focuses only on select service, or they're diversified across the different segments? Do lenders think about that, or do you think they will start thinking about that in terms of a specialization? Does that matter?
Well, I think it does yeah, absolutely. I mean, your lender wants to know, your specific business plan kind of holistically versus just focusing on, one individual deal. Is this something that you do regularly? What's your track record of success? How long have you been doing it? Yeah, I think all that matters.
Yeah, and just to piggyback that, I think we're talking about lenders and putting lenders in one box. There's a wide variety of lenders and kind of what they're looking for in the market. We're out in the market right now shopping debt on a couple of deals, a few deals, and the difference between the high and the low is huge. I think that this is a point in the market where you do need to shop. You can't necessarily just go back to that one relationship lender. You probably need to have multiple relationships. And what we've seen, and not just now, over time, is if you hit that lender that has a hole that asset fits, they may be much more aggressive than if you're just going to one lender who maybe it's not a fit for them that day, or their bucket's more full. We're seeing much greater difference between the top and the bottom.
Before we move on to the equity side of things, I would be remiss if I didn't ask the question as it relates to construction lending. I actually had a conversation yesterday, and I think someone brought up a very good point, which is if we look at the debt markets today and we consider this all just to be noise, right? And you need to get past this noise, and you look at a ground-up construction deal, right? You're looking at 30, 36 months down the road from now. With that kind of runway in terms of months, get past this noise, get past what people are thinking about in terms of whether this economy does go to a recession or somewhat of a recession. It seems like it makes sense, right, when you look at that runway, but the question is there any debt out there to do construction?
Yes.
Okay.
So we're an active builder. We have about 36 development deals in various stages in our pipeline. On the lending side, we're an active construction lender as well. The pool has gotten much smaller. But taking that a step further, when you look at the developers that are out there, you have developers that are developers and they're building for building's sake. But from an economic perspective, a lot of development deals don't make sense today, just because construction loans are very expensive. Construction costs have gotten very expensive. And looking at our inflow of construction deals, a lot of those deals die on their own, before we ever have to make a credit decision, when they get pricing and stuff like that back. But as I said before, I'm a big believer that new wins over old, and particularly when you're talking about power brands, I think there's a strong argument for development. I personally like the development story. Whatever noise we're in today, you're capitalizing that risk for the next 24 months and hopefully opening at a much better point in the cycle. If you have a good GC, you have a good plan to get it built, I like that story, but it's only going to work in markets where you can justify the rate and the demand is there. And for those projects, I think there is construction debt out there. It's a lot harder to get it done today.
Can we really build more hotels in Nashville?
Continue to absorb it.
It's a great point on the market by market. We have 2 projects that will start this year, for example, that are both in drive-to leisure, very diverse oriented markets, where we're going to be able to develop at a lower price point than a significant amount of recent trades in that market. So that gives us great confidence in each project. I mean, will our construction period interest be higher than we originally underwrote? Absolutely. But that is not going to prevent us from developing in this environment.
We remain really bullish on development at this point for all the reasons that have been laid out. It's been a big component of our growth strategy over the last 20 years, and we've done it through development takeouts, where we've essentially leveraged the strength of our balance sheet and local developers' knowledge of the site and market and their relationship with their bank to secure financing with the takeout and our balance sheet essentially. And that's really where I see a number of opportunities today because it is so challenged and it's a real tailwind for the industry in terms of supply, but to the extent you can find those right markets that have RevPARs to support the higher construction costs, I think it's valuable time spent today exploring those opportunities because I think they'll pay off in the long run.
Before we move on, any questions from the audience? Certainly like this as interactive as possible, and certainly want to give you guys a chance to ask questions as we go along. Anything right now? Anyone?
I know you guys talked about lenders. I want to kind of ask you a question about construction costs overall. I know you guys have said construction costs are going higher, but do you see because of interest rates going up, people are not as developing as much because of the cost that would you, when you're underwriting, would you lower your construction cost on that? Because there's going to be less development, more subcontractors, more bidding, and you can get better pricing? Or do you just go with the high price right now?
We don't believe costs are coming down. Maybe the rate of increase, may come down as, inflation begins to come in, but, I think there's only been one period in the history, like 08, 09, when costs actually came down. So it's just a decrease in the rate of increase, from a cost standpoint.
I think that's right. I think within the construction budget, you may see certain line items come down. We're hearing, and I talk to my construction team about this all the time, are costs going to come down? And to Ben's point, construction costs don't really come down. If construction costs come down, it's probably because we go into a deep recession, which isn't good for anyone here. We think that they're going to be stable, but I think you will see, certain trades, we have certain situations, where a GC, quotes us a number, and then, another project falls out, and he says, okay, well, if you can sign it this week, I'll do it for whatever, because he has a hole, but we're not seeing material reductions. I think it's more just movement and a slower pace of acceleration.
Out of curiosity, with respect to the increase or continued thought of increasing construction costs, a pullback of leverage, and we'll talk about equity here in a second, do we think that any of those things, when you look at the assets that are going to be ground up built or constructed, do we see them to be physically different? Are they going to be smaller, not necessarily smaller room count, but smaller square feet, different amenity space, smaller amenity space? Do we see what has typically been out there that's been being constructed, from the brands? Do we see those changing to take into consideration these things?
We have an Embassy Suites in Madison, Wisconsin, downtown under development takeout. And historically, that box has been a less efficient box. We were able to find significant savings from a square footage, both in the public and guest room space for that development. And brands have been willing to work with us in the near term as their pipelines have slowed as well. So, I think Homewood Suites, for example, just went through a complete revamp of their prototype to allow more guest rooms and smaller square footage. So it's present in most, if not all, of the brands today. That construction remains elevated. They want to continue to build a pipeline, and they're working with you to accomplish that.
Just one component to programming that we have been focused on with most of our, or really all of our new development deals, is the incorporation. When you think of select service and extended stay, you don't necessarily think of group business and meeting space associated with that product type. But we found, and certainly with a lot of the smaller and medium-sized groups, that are traveling now and meeting coming out of the pandemic, that there is more of a need for some level of meeting space. So we are choosing to kind of increase the square footage of meeting space. We want to make sure that we can, even for a call it 165 room select service property, we will likely program in, call it 3,000-ish square feet of meeting space, where the prototype may have a 600 or 1,000 square foot room. But we want to make sure that we can accommodate multiple types of demand, not just that traditional corporate transient guy that used to, or traveler that was the focus of that property type, recognizing that kind of demand patterns have shifted.
Markets have also been huge, property-specific markets. So the suite shops within hotels have been kind of a silver lining through COVID as well. And so we've rethought through what that space is in a hotel too, and how we might capture a little bit more of the consumer in their stay.
Okay. So, one of the last things we wanted to, a couple other things, but one of the main things we wanted to talk about was equity, right? So we've talked about the deals themselves, talked about what things may look like now in terms of the physical asset. We talked about what the debt looks like. The other side of this equation, obviously, is equity, right? And as we said, formulaically, it used to be 60-65% loan to value. You go out there, 35%, 30%. On the equity side, a lot of people were raising it from friends and family and alike. But with all this pullback, I think the question, over, through the pandemic and up through the last year, it's, you hear the anecdotal information about there's tons of money on the sidelines, right? There's tons of money on the sideline waiting for investment, right? People have it. They want to get it out there. They want to get it deployed. Do we really think there's significant capital on the sidelines to deploy in these types of assets, whether it's ground-up construction or it's acquisition? And what do we think the equity markets look like? And with debt being compressed and equity obviously need to be a bigger demand, do we see people kind of looking at that and understanding that, well, maybe our returns can be a little bit higher than they used to be because the demand's going to be greater?
I could start. I don't think our collective return thresholds have changed much. I don't think we're underwriting to any less than we would have a couple of years ago. I think it's just being more selective and the assets we're pursuing and the time we're spending on those assets. When we're talking about the cost of capital and equity, we're all underwriting similar products. There's in-place yield, and then there's exit value and reversion cap rates. I think that there's more of an emphasis on what's your exit cap in 5 to 7 years versus it's not just the same as your going in rate. I think there's more scrutiny on that. That's going to drive a lot of the value here. And then another thought on sort of the equity component and sort of what we're underwriting to. what we're seeing in the market today is there's still a bid-ask spread between buyer and seller. That remains because of the cost of debt is one of the major factors. We are finding success being more creative with the seller on the equity stack to solve for whatever that spread is, whether it's an earnout, whether it's staying in the deal, whether it's a mezz piece for seller financing. But I think, going back to the opening comment, I don't think that the market shifted in what they're expecting from a return threshold.
Yeah, I think from our perspective, there is a lot of equity on the sidelines, and at some point, I think a lot of that equity will come back into the market. The question is, at what point? As you look at the volatility, everyone raises an opportunity fund because they think there's going to be distress, but then when there's that distress and they can jump at it, they're sort of afraid to actually make a move. So I think you have a lot of capital on the sidelines that's trying to sort of figure out where the opportunity is. And I think a lot of people are afraid to jump too early. And a lot of people say they'd rather jump late than early. But I think what typically happens is if you jump late, when you jump, everyone else is jumping at the same time, and all that equity comes back into the market. For us, as we look at our portfolio and we look at different investments, I look at not only return, but what's the risk-adjusted return. If I have, an absolute down-the-middle deal, I'm taking on a lot less risk than if I'm doing something that has, say, a heavy renovation or, there's other complexities with it. And if I'm going to take on the complexities, which we're happy to do, and that's, where we've kind of built our business, I should be getting paid for that risk or compensated for the risk that we're taking on. So we look at everything that way in terms of how we're pricing it. It's not, we're not just solving for a 20, or, whatever the number is. There are some deals that are lower and some deals that are higher than that for a specific reason based on the risk that we're taking on. But I do think you have a ton of equity on the sidelines, and sort of the same statement I made about the lenders, I think it's the same thing with equity, whether you're talking about, LP equity versus family office versus other types of equity. They all have different risk profiles and look for different things and, have different headwinds. So I think they all will jump in or hopefully jump back in at different points. And if you're looking to raise equity, it's sort of knowing where's the money today, who's looking to get in, making sure that you have the right investor pool so that when you're comfortable making that leap, you have the capital stack that can go along with it. Because in this market with all the volatility, smart sellers are not going to select you for a deal unless they're really comfortable you can get to the finish line. And what we're hearing on a lot of deals is not necessarily the highest price, but it's the best offer in terms of, you might get this crazy offer, but if I'm going to waste the next 6 months screwing around with it and then have to go back to the market, it's not worth it. I'm better off to go with the short thing and get it across the finish line, particularly in this market with the volatility.
So Mike, you mentioned that you guys are, you're not looking at underwriting the return any differently than equity. Are you looking at the same hold periods that you've always, or are hold periods getting longer?
No, hold periods haven't changed, 5, 7, 10 years, depending on the asset and the profile. What we are spending more time on is underwriting downside scenarios and recession cases. Not to, think the world's going to end, but what happens if in 2 years there's another event, and how can you absorb that in the deal profile? And that goes back to Brian for risk adjusted, and you have a bandwidth that you're comfortable with. So we're spending more time on that.
Is there any thought that if when you look at what's going on in banking right now, and people start worrying about the banking, is that are equity providers out there looking, I need to get my money out of, in terms of banks or markets, and into physical assets? Do you see an influx of equity for that type of perspective, or you just think it's noise?
I think it's too soon to tell, but I haven't seen, signature movement.
Yeah. Okay. Question?
In reference with the project cost, ground up construction, and replies for your PIP, are you putting contingencies on supply chain? Obviously, there's delays in product, and are the lenders looking at an additional contingency on supply chain issues?
We haven't formally done that, but certainly if we run into a challenge and we're not able to get, whatever the product is to complete the reno, I think supply chain is certainly a rational discussion to have with your lender. And again, it just gets back to the relationship that you have with your brand and your lender, and everybody coming together to understand that it's a tough time for delivery of certain items.
Back to this side of the room all morning. Any questions over here? Any thoughts, ideas? All right, last piece before parting shots was one of the things when we've talked about is we've got debt, we got equity. We've again looked at historically how deals have been done. There are some alternatives out there, right, that can help fill that gap if we're going to have pull back on leverage to 50%, somewhere in that neighborhood, and the equity is a certain number. There's a 15-20% gap that might need to be filled. There's some alternative solutions that have existed out there, that have kind of been the fringe. In some cases, there's PACE financing, there's TIF financing, there's tax credits of all different types, and one that you hear every now and then, and I'm not sure I call it equity, but crowdfunding is one of those things. What are you guys' thoughts on these alternatives that can maybe help fill that gap on a certain deal if it makes sense?
I think it's important to explore those opportunities to the extent they exist. I have not necessarily seen, because of COVID, an increased pace relative, and certainly with the more recent turmoil, relative to what we saw pre-pandemic. But that's my own kind of experience there. I think you have municipalities and governments that want growth, but they're also going to be strapped from a cash component in the near term as well. So I don't see an increase necessarily, but you definitely want to take advantage of what's available for the specific deal you're looking at.
Yeah, I mean, the recap opportunity, over the next couple of years should be meaningful, but there may be other ways to handle it than what you mentioned. Preferred equity, I think, will likely be, a very meaningful opportunity for those that want to, play in that space. Preferred, or, just some kind of a recap where you agree on a value, and then new equity comes in, sits alongside, the equity that's been in place, and you carry on as partners. So there's a variety of ways to structure it.
Yeah, I think that makes sense. I think there's a huge opportunity out there for preferred equity, and we've made a number of preferred equity investments. On the other side of the capital stack, under Stonehill, our lending platform, we have Stonehill PACE, which is a national PACE lender. And if you're not familiar with PACE, it's clean energy financing, and it's structured where it's an assessment versus a loan, but it's pari passu with your property taxes. So if you're doing ground-up construction or a major renovation, and PACE is only available in certain states, we're finding it to be a really good solution. And because of the way that it's structured, the cost of PACE is significantly less than mezz or pref equity. So we're seeing in many cases today where it actually helps you bring down your cost of capital, because in many cases the cost of the PACE is actually less than your construction loan, so you're able to effectively blend down your rate. Now, with that said, your construction lender has to consent to it. And what we see a lot of times happening is the construction lenders that'll consent to it, they'll reduce the size of their loan, but they'll consent to PACE effectively being, pari passu with your property taxes. So as a developer, you're able to get more proceeds, and your lender is happy because they're able to shrink the size of their loan a little bit. So it becomes, a win-win.
Yeah, Brian, with respect to PACE, one of the things I've seen PACE, because in certain cases it can be also retroactive, is
Correct.
I've seen developers use it to actually help them bail themselves out of significant cost overrun issues that they hadn't contemplated it on the front end, but because it can be retroactive, they use it as a bailout, so to speak, to help them, handle those cost overruns.
Yeah, that's right. I mean, we've done a lot of retroactive PACE, and again, it depends on the state, the jurisdiction that you're in. It's not a national program, so each jurisdiction sort of makes their own rules, but where you can do retroactive PACE, we've seen it for major cost overruns to help solve that bust where your construction lender says that they're not going to put any more dollars in, and a sponsor may not have the equity, but the construction lender will consent to it. We also saw it during COVID for newly developed projects where they just needed money, to fund operations. The hotels were struggling, where we were able to come in and do a pace assessment, to effectively retroactive against the construction, but they were able to use that to help bail themselves out as well.
Before we get to panel's parting shots, one last inquiry from the audience with respect to questions. Right here.
Where do you see interest rates stabilizing, maybe at a 50% LTV and a 65% LTV for hotel financing for well-performing deals?
My crystal ball is not that good. Yeah, I mean, it's with the noise in the market today, it's kind of hard to say. I'm sort of hopeful that with some of the banking noise, it helps the Fed slow down a little bit, so we don't completely break the system. But obviously, with the banks having the issues that they're having, that's created other issues. So, yeah, I don't know. I'm curious to hear what you guys think.
In times of Fed fund rate increases, eventually the spread comes in. We just haven't have not seen enough yet for that to happen. So I agree with Brian. We need a little bit more visibility and a little less uncertainty before that really becomes more clear.
I mean that's a good point that Ben made too. When you think about the rate that you're borrowing at, there's two components to it. There's effectively the risk-free rate and then the risk premium. And this is really one of the first times in history where you saw the risk-free rate blow out and the risk premium blow out. Historically, what's happened is the risk-free rate went up, the spread would pull back. I think that's more of a factor of supply and demand of capital in the market. So like when you look at a lot of the lenders that are out there, I got asked at Alice, well, what happens if the Fed moves rates 50 bips versus 25 bips? I said, I don't think that's the right question. The right question is, who's actually out there lending? Because if no one's out there lending, regardless of what the Fed does over 25 bips, if lenders have the ability to push spreads out or the market warrants that based on supply and demand, you're going to have wider rates. I think as more lenders come back into the market, it creates more competition. Eventually, CMBS will come back. That creates more competition. And you'll see that the spreads come in a little bit.
No, go ahead.
Nelson, you talked about markets where RevPAR, find those key markets where RevPAR is elevated and underwrite those projects. I didn't hear the panel talk about risk for RevPAR actually shrinking and now projects go upside down. What are your thoughts on things like that?
No, that's a great question, and exists both on development and existing deals. As you're looking at markets, we've seen some just huge outperforming markets over the last 2 or 3 years. I think in your own underwriting, you would likely want to look to taper that back some. And you're seeing that pullback in some of those markets today. But my experience and most of our underwriting in those markets, broadly speaking, is that it's still stabilizing above 19 levels. And so it's finding those markets that even with a slight dip from current performance, is still stabilizing above 19 levels and supports the overall development or existing acquisition.
Anyone else? All right. Parting shots.
I remain really continued optimistic in the industry. I think there's a lot of fundamentals that remain healthy for us. As I mentioned, weekday performance continues to improve within our own portfolio. Weekend continues to remain sticky and perform well for us. Supply is a huge tailwind for the overall industry at large, and while there are a lot of macro concerns, I think as you build out your portfolios and are specific in the markets you go into, there's a lot of positives I think we can focus on in this industry. So I remain glass half full at this point.
I think it's about patience. You know, I mean, we're in a period where, you know, we're all very busy. It just feels less productive, and you know that's frustrating. And you know, for those of us that have a lot of capital to put out, yeah, I mean it. You know, but we've been through this before, so you know we kind of know that you know it is cyclical. We're in this period of uncertainty that creates the you know the lack of movement and the lack of transactions. But again, back to the point of you know commitment to the industry, you know which you know keeps you in the deal flow, keeps you you know with the relationships with your brands and lenders. If you stick to it, you know I think I agree with Nelson that you know the opportunities will present themselves. We're just in a you know, a weird period, you know, where you need to exercise patience.
Yeah, I think if you look at the market today, I think hotels are the most investable asset class for CRE. I think we have great tailwinds. You know, a couple of the panelists talked about their portfolios. Our portfolio is up to 2019. We're seeing, you know, great budgeting for this year. We have, you know, strong expectations from an operational perspective, and I expect that to continue to run. I think a lot of the challenges that you're seeing in the market today is capital markets related. You have a lot of owners that are stressed, you have lenders that are stressed, and you know that's creating a bit of volatility. But if you can work through that and get good deals done today, you know we're an industry that changes our rates by the night. You know, occupancies, you know, demand is back to peak levels, and I don't think we're firing on all cylinders yet. I think there's a really bright future for us, and I think some of the noise in the capital market side, I think, just creates opportunities for, you know, for those people that are well capitalized or patient and can pick their spots.
Any last words?
Yeah, and everybody pretty much covered it, but fundamentals are strong, equity is there, capital markets need to settle out, and with muted supply, I think we're in good shape.
Well, I thank all four of these gentlemen. Round of applause, please. Thank you.